The pickup market is on the brink of collapse. Imagine your truck's trade-in value evaporating by $20,000 in a single afternoon, while your monthly payment stays locked at nearly $1,000. For 3 years, the pickup market felt like an unstoppable money machine. But the data on my desk right now is terrifying. We are watching the fastest inventory buildup in automotive history. Dealers who were charging $10,000 markups are now staring at lots full of unsold trucks they can't give away. But here is the critical part. One specific trigger event, currently happening at wholesale auctions, will determine exactly when the floor falls out. If you buy now without knowing this number, you're catching a falling knife. I'll show you exactly how to spot the crash before it hits your driveway. The inventory overload. The first sign of the collapse is the massive shift in days supply on dealer lots. During the shortage, dealers had a 5-day supply of trucks. Today, brands like Ram and Ford are seeing some models sit for over 120 days. This creates an unsustainable carrying cost for dealers, who are paying high interest rates, known as floor plan interest, just to keep those trucks on the lot. To put this in perspective, a dealer with $15 million in inventory used to pay maybe $15,000 a month in floor plan interest, back when rates were near zero. Today, with prime rates elevated, that exact same lot size is costing them over $85,000 a month just to let the vehicles sit there and collect dust. And it gets worse when you look at hidden inventory. Many manufacturers are hiding thousands of fully built trucks on secondary airport runways and storage lots far away from primary dealerships, trying to keep the official supply numbers looking artificially low. This is a desperate attempt to protect retail prices from a collapse. When you walk into a dealership right now, you need to exploit this pressure. Look for trucks with aged inventory stickers, or those parked at the very back of the lot, where the physical paint is starting to look slightly dull from weather exposure. These are the units the bank is threatening to cut off. If a truck has been sitting for more than 120 days, the dealer isn't just willing to negotiate, they are desperate because their lender is charging them double-digit interest penalties on that specific VIN. You can often peel back another 5% off the invoice price just by asking to see the vehicle's in-service date or floor plan age. But inventory buildup is just the surface. The real disaster is hidden in the dark side of the credit market. And what's coming next is going to shock the used car world. The repo and auction glut. While new trucks sit unsold, the used market is being hit by a surge in repossessions that we haven't seen since the financial crisis of 2008. During the peak, buyers took out 84-month loans at 120% of the truck's highly inflated MSRP, meaning they paid luxury prices for average work vehicles. Now that the stimulus economy is over and inflation has squeezed household budgets, these over-leveraged buyers are defaulting. Those trucks are flowing back into wholesale auctions in record volumes. I'm talking about thousands of late-model F-150s, Silverados, and Rams hitting the lanes every single week. This is the negative equity trap. If you owe $50,000 on a truck that is now worth only $35,000 at wholesale auction, you're effectively a prisoner to that vehicle. If you try to trade it in, that $15,000 deficiency has to be rolled into your next loan, pushing your payments even higher. This has created a massive bottleneck in the market where average buyers are completely paralyzed, causing retail transactions to grind to a halt. Compounding this is the massive volume of lease returns from the 2021 and 2022 peaks that are starting to hit the market. These trucks have residual values based on bubble-era prices that no longer exist, forcing leasing companies to either take massive multi-million-dollar losses or dump them at auction to get them off their balance sheets. This creates a secondary layer of downward pressure on the used truck market that cannot be stopped. And if you think the prices are low now, wait until you see how the big manufacturers are accidentally sabotaging their own dealers with the interest rate trap. The interest rate trap. The real silent killer of the market is the massive artificial gap between manufacturer subvented rates and the real market coordinate. Ford, Ram, and Chevy are desperate to move new metal, so they are offering highly subsidized financing like 0% or 1.9% APR on brand new $80,000 trucks. However, if you look at a 3-year-old used truck, the interest rates are averaging between 9% and 13% for most consumers. This creates a terrifying math problem for the used buyer. A $45,000 used truck financed at 11% interest can end up costing you the exact same monthly payment as a $65,000 new truck financed at 1.9%. This has completely destroyed the classic value proposition of buying used. Manufacturers are effectively cannibalizing their own franchise dealer departments by making their certified pre-owned inventory financially toxic. Private sellers are also stuck because they can't compete with the subsidized financing offered on new models, leading to a complete freeze in the peer-to-private market. As a smart buyer, you need to analyze the LTV, or loan-to-value ratios. Most regional banks are now panicking, tightening their lending standards and refusing to finance anything that isn't a flawless Tier 1 credit deal. We are seeing more lender rejections today than we did during the height of the 2020 economic lockdown, even for people with decent credit scores. If you don't have at least 20% to put down right now to offset this interest drag, the banking sector is signaling that you are buying into the final stages of a giant asset bubble. But the biggest structural mistake the industry made wasn't about interest. It was about who they thought we were and what we could actually afford. The luxury overreach. For years, manufacturers made a massive, arrogant bet that every truck buyer wanted a rolling luxury lounge with massaging seats, panoramic sunroofs, and $90,000 price tags. They systematically killed off the basic, honest work truck with low trim options to chase high-margin profits. Now, that pool of high-income buyers has dried up, and the working-class consumer has been completely priced out of the truck market. We are seeing an organic buyer's strike, where people are looking at these exorbitant payments and simply choosing to spend $3,000 repairing their 12-year-old trucks instead of signing their lives away on a lease. This massive push for gadgets has backfired spectacularly because modern trucks are too complex to repair cheaply, leading to skyrocketing insurance premiums that add another $200 a month to the running costs of ownership. This is why the trim levels with the highest luxury overhead, like the Ram Limiteds, GMC Denali's, and Ford King Ranches, are currently experiencing the most violent price corrections at the wholesale auctions, dropping 20% in value in just a few months. The market has realized that the value of a truck is in its utility, not its leather-wrapped dashboard. Even the manufacturers are starting to realize this as they quietly reintroduce basic, low-spec trims. But it's too little, too late. The trucks that will actually hold their value in the coming years are the utility spec or mid-tier consumer trims, because that's the only asset class the average worker can still realistically justify on a standard mid-range salary. However, even the basic trucks aren't safe until you understand the one data point that tells you exactly when the bubble will officially pop. The wholesale trigger. The ultimate fail-safe signal to watch is the widening spread between the black book wholesale auction values and the actual retail asking price on dealer websites. Right now, wholesale auction prices are plunging twice as fast as the retail sticker prices. This means dealerships are desperately trying to hold the line on their retail margins to recover the losses they took on cars they overpaid for last year. They are keeping their online prices artificially high, hoping a naive buyer will walk through the door and payload the difference. Dealers are hiding behind reconditioning fees and mandatory dealer add-ons to keep their listed prices high, even as the ground shifts beneath them. But this is a game of chicken, where the dealers are holding a melting ice cube and they are preparing to blink. They cannot hold this stance past the end of the next quarter, when tax payments and floor plan interest bills come due. To win in this climate, you must use real-time market tools to pull actual local transaction data, rather than trusting the manufacturer's suggested retail price. If you see a major $3,000 drop in auction prices over a consecutive 30-day period, that is your signal to keep your cash in your pocket and wait another month. The correction isn't a slow slide, it's going to be a cliff. When the large national franchise groups finally start liquidating their excess stock to satisfy their banks, the downward price correction will be measured in the thousands, not hundreds. Don't buy the dealer's hype. Watch the raw wholesale data.